Good day. Welcome to Ike Tutorials. My name is Prince Owusu, the level 300 business admin student, and today I'm taking you through IAS 40, which is the investment property. So, with the investment property, it's quite similar with the IAS system, which is the PPE, but it's what's different. The only difference is that you see PPE and the investment property, they are all assets that are owned by a company or let's say an institution. But the difference is that for the PPE, is the company that uses it for their what, for their product or let's say for their work. So the company uses it for themselves. But with the investment property, the company will buy the assets and then use it for hiring. So the company will not necessarily buy the assets to use it, but rather they will be what, hiring it out for people to what, to use it. So the main thing about this is investment property. So when you talk about investment property, they are assets owned by a company which is not used by them but for hiring. So this is the simple definition of investment property. So when you talk about the investment property, it's the assets owned by a company which is not used by them, but for what, hiring, or by what, but for other companies. So in simple terms, you can say that for the investment property, they are what, assets that are used by what, different companies, but they are not for them. So let me give you a practical example. Let's assume that UPSA has bought, let's say, has bought a vehicle, but the vehicle that they have bought, they don't use it for any related work for UPSA, but rather they hire it out. So let's say if a church want to travel to somewhere, then the church will come and what, hire the bus, or maybe an institution want to go somewhere, then the institution will what, will come and then hire the bus and go. But the UPSA itself that bought the car or the bus does not use the bus for anything. So that's what we call what, investment property. So the property that we have, we are investing. Unlike the PPE, for the PPE, the companies use it themselves. So everything relating to the PPE, which is the IAS system, is the company that we what, we calculate on. But with this one, they are what, hiring it out. So remember, when you're hiring anything out, we calculate for the risk involved, everything before we hire it out. And when you're hiring it out, since we are talking about assets, so the assets can be maybe plants or equipment. It can be land, building, etc. So let's take these three examples. So plant and what, equipment, plant or equipment. So when you take the plant we use it to, let's say, whenever there is no light, then the company will what, use it. But here UPSA bought this plant not necessarily to what, use it, but what, to rent it out, because UPSA have what, plant already, but they have bought additional plants. You understand? They have bought additional plant which they are not going to use it for what, their purpose or for their work, but rather when an institution wants it, then they will come and what, hire it out. Let's talk about land. So with the land, a company may decide to buy land and then what, use it for rent. So let's say UPSA will buy another land at, let's say, I want to use this example. So let's say languages. You see the park over there. The park over there has languages. So UPSA can decide to buy that land, but they won't use it for anything. They won't go and build any house or, like, let's say, any story building on it, but rather they will give it out to people for what, programs. So UPSA that is owning the land or there, or that have bought the land there, they are not using the land for their purpose, but rather they are hiring it out for another what people or another company to use it. That's what we call what investment property. So we can also talk about what building. So with the building, the company can decide to what buy a building or maybe build one. So building a house or something, the company may decide not to use it for their purpose, but rather to hire it out. So they can hire it to another what company or another institution to use it for their what businesses. And remember, when you are hiring something out, remember you generate what? You generate income. And not income, it's not only income that you generate. Sometimes you generate what? It's not sometimes, like every day you generate what? An expense. Because the company can tell you that, okay, since you are coming to hire my house, these are the conditions. Okay, so don't maybe don't litter the place or everything. So assuming that after the program or after everything and the place is what littered, well, you the company that you own the property, what are you going to do? You are going to what? Clear off the place for the place to be neat. So you clear off the place. Remember, it's going to be an expense because the people who are going to do that, you have to what? Pay them. So it's going to be what? An expense. And you renting it out, remember, people are going to what? Pay for what? For the asset. So you paying for the asset and people are what? Also paying for them to use it. You are going to get what? An income. So there are certain things that we consider here. So the first thing that we consider, things to consider about IAS 40. So with the IAS 40, I'm just talking about what? The investment property. So the things that we need to consider, the first thing is what? The price. So we can say what? Purchase price or what? Cost. So we have our purchase price or cost. So purchase cost. And then cost to rent. Cost to rent. Depreciation. We have cost to rent, depreciation. We have our income. And then we have what? Expenses. So these are the listings that you can what? You'll be expecting about investment property. Now, the first one is, remember, the investment property, we are saying that it's a company, let's say UPSA, have decided to buy what? A motor van. But the motor van that they have bought, they are not going to use it for any UPSA related what? Works. They are not going to use it for the purpose of what? The UPSA what? Activities. But rather, they have bought it for people to come and what? Rent it out. So they always rent it out. So this is the money that you use to what? You use to buy. So this is the what? Cost of what? The investment property. So for the investment what? Property. Now, cost to rent. Remember, when people are coming to rent, they what? They will pay. So when they are paying, that's what? That's the cost of what? Rent or cost to rent. So the payment that people will make. So if UPSA have bought it and let's say languages want to use the bus to, let's say languages have a program at, let's say, Gempa, and they don't have a bus to go, they can come to UPSA and talk to them that we want to rent your bus so that it can convey us to Gempa. So they agreeing on what? Agreeing on giving the bus to the languages people. Remember, UPSA will take an amount what? Amount from the languages people in order to what? Let them use the bus. So that's what? The payment, which is cost to rent. Now let's talk about depreciation. Remember, in assets, we always consider depreciation. The money that you will use it to buy asset today will not be the same as what? The money that you use to buy the asset tomorrow. That same asset what? Tomorrow. That's why we calculate for what? Depreciation. So the depreciation, to remember, is an asset. We are talking about assets here, which is what? Investment property. We are talking about assets. So we always what? Calculate for what? Depreciation. And for that one, we know the straight line or what? The reducing. That's the two methods which I explain in the what? In the IAS 2. So you can refer to the video and then what? You know how to solve for that. Now, we are renting out what? An asset. Remember, when we are renting out an asset, we will generate what? An income. So let's assume that we've bought the asset this year and people are renting. the money that they are paying to us in order to get our assets to use it is what? Our income. So this income is what? The money paid to us. So paid to the owner of the assets. Owner of the assets. So pay to the what? Owner of the asset. So the language is they will pay a certain amount of money to UPSA in order to what? Get the bus to use it to what? The game part that they are going to do their program. So the money that UPSA will what? Receive from the languages people, that will be what? An income on what? The investment, which is what? The plant, or let's say the bus. So the money that they will get, we consider it to be what? Income. We don't consider it to be what? A cost, because we bought the asset, and since they are paying for it, we have to what? Deduct it from our cost. So we what? We subtract all our costs from it, and then we say that we are now what? Making an income. No, we don't do it like that. We've bought the asset already. So right now, if they are coming to rent it out, the money that they will pay, it is called what? Income. That we the company, we are going to receive, which is what? UPSA. Now let's talk about the expenses. Remember, once we are out hiring once you are hiring assets, so let's say the bus, assuming that the languages people has what? Have gotten the bus to go to Gempa, and when they came, they have given us what? The bus. They didn't say anything like, oh, maybe the bus is 40 or something. No, they didn't say anything like that. But when we went to check, we noticed that there is what? An engine breakdown of what? The engine. So what do we have to do? We have to fix it, because it wasn't part of the agreement that if in case there is 40 or something, you have to fix it. You understand? So we have to fix it, and when we are fixing it, remember, it's what? It's considered as what? An expense. So we will what? Pay. So payment in fixing the asset. So let me use the land to also what? Explain this. So let's say you've bought a land and you are renting it out for people for what? Programs and other stuff. So as I said, let's say the languages people are using it for a certain program, UPSA land, and the languages people has what? Rent it out for a program. So they told them that what? When they are done, they should what? Leave, let's say in 24 hours, they should leave the place. But when languages people were leaving, they littered the place. So what do UPSA have to do? They have to clean up the place for it to be attractive to another what? Another people, for them to come and rent it out again. So the people that UPSA will employ to what? Clean up the place or tidy up the place, you have to what? Pay them, and that will be considered as what? An expense, which UPSA has to what? Pay. So when they talk about investment property, which is IAS 14, these are what? The things that you are supposed to know. And remember, the investment property too, we can what? Revalue it. When you go to the PPE, we say revaluation. But here, when you come here, we say what? Fair value. So PPE, they will tell you that calculate for revaluation loss or revaluation what? Gain. But when you come here, we talk about what? Fair value loss or fair value what? Gain. So it's the same principle that we use in solving the fair value gain or what? Fair value loss. You have to calculate for your carrying amount, which is your cost minus what? Accumulated depreciation, and then you compare it to the amount, the fair value that they will be giving to you in the question, and then you what? You determine whether you get a loss or what? A gain for the fair value. And when you get a gain, remember it will become what? An income, as I explained in the PPE revaluation. And when you get what? When you get like a loss, remember it become what? An expense, which you have to what? Treat it in a financial what? Position, or a statement of what? A statement of position or financial statement. So these are the things that you are supposed to know about what? Investment property, which is IAS 40. So let's solve a question to delve in. So as I said, we have something we call what? Fair value gain, and then what? Fair value loss. So let's take it here. So let's assume that they are saying you have to calculate for a fair value gain or what? A fair value loss. Remember, you'll be given what? Cost, which the cost sometimes we may what? Calculate for the carrying amount. So the carrying amount will be cost minus the accumulated what? Depreciation. So accumulated depreciation. So this will help you to determine that whether you get a loss or what, a loss or an income. So when you get an income, remember we call it what? So we call it fair value gain. This is what, when you get what, an income or surplus, and then we have what, the fair value loss. When you notice that the figure that you are supposed to what, sell it today is what, lesser than the figure that you used, or the amount that you used to what, purchase the real asset. That's what, your fair value loss. So after calculating for your carrying amount, remember they will give you what, a fair value for the assets. Fair value for the assets. So the fair value for the assets will determine. So you compare the two, which is the carrying amount and the what, the fair value, which I have taught you how to what, how to solve for the carrying amount already. And here, so here when we get here, we just have to what, we just have to run through because we know it already in PPE, which is IAS 16. So the fair value for the asset will be given to you in the question, and then they will tell you to calculate for fair value gain or fair value what, loss. Is the same as revaluation loss and what, sorry, revaluation surplus and what, revaluation loss. So it's the same what, the same procedure that we use to what, calculate for this. And then they can ask you, after solving for all this, then they will ask you to what, they will ask you to prepare the necessary what, financial statements. So the financial statement that it will be required here is are two, which is your profit or loss statement, and then what, we have the statement for financial position. So your profit or loss, let's say we have what, profit or loss statement, what, extracts. So if you have this, then you come, we have what, income. So we have income, then you underline, and then you have what, your CD sign or your currency sign. So income here is when you get a fair value gain, it will come here. So fair what, value gain. So the fair value gain will what, come here. And then let's say the question has stated what, an income. Let's say when you are renting the asset out, you will be getting an income of, let's say, 5 cedis. So the income will also what, come here. So it will be what, income on investment property. So that one too will what, come here. And then you go to what, you go to, let's say, an expenses. So expenses, remember, is what, an extract. So we are not supposed to calculate for everything, which includes what, which is included in the financial profit or loss. So the expenses, remember, we are dealing with assets, and always depreciation is what, key. So first thing we have to calculate for what, our depreciation. So we have our depreciation here, and then secondly, they can tell you whether you had what, a revaluation loss. So if you have a revaluation loss, it means what, an expense that you have to pay for. So we have fair value what, loss, not revaluation. So fair value what, loss. So we have our fair value what, loss. And this one too, in the question, they can tell you that for you renting the asset out or the property out, there was an expenses that you catered for, or you after renting the asset out, you incurred what, a certain expenses. So the expenses has to also what, be here. So any expenses related, so expenses, that one to what, has to come here. And remember, it's what, an extract. So we don't add anything here to calculate for the profit or the loss. We don't add anything here. Now the next one that they will ask you is, so let me rub here. So the next thing that they can also what, ask you to let's say solve for or prepare is your statement of financial position, assets. So that one to you see this sign. And remember, statement of financial position, we are dealing with what, assets. We are dealing with what, assets. As I said, investment property is what, an asset. So you have what, assets here, assets. Now when you get to the assets, remember, we are going to use the fair value what figure that has been given to us in the question to what to prepare the what statement of financial position what extracts. You understand? That's what we are going to what use for. So you come here and then you write what investment property, then you bring your what you bring the fair value here, because the fair value is trying to tell you that right now if you want to buy the asset, this is what the figure, that's the fair value that you can get the what the asset for. Or it's telling you that right now if you want to what sell the asset out, this is the figure that you can what sell it out. And remember, financial position, we are only dealing with what the final value of the asset. That's what we want. So asset, the date that will be given to us is what we are going to use. So this is what the overview of investment property. So right now we are going to delve into solving the questions for us to get to know how the question can be. So we have a question here. Now, the question is requiring us to A. Calculate the fair value gain or loss on investment property for the year ended 31st December 2024. B. Prepare the extract from the statement of profit or loss for the year ended 31st December 2024. C. Prepare the extract from the statement of financial position as at 31st December 2024, showing the investment what property. So this is the question. Aburi Properties Limited owns several commercial buildings which is rent out to earn income. The following information relates to one of its investment properties for the year ended 31st December 2024. So the items, we have cost of property, we have accumulated depreciation, fair value of the property, rental income earned during 2024, and then we have what repairs and maintenance expenses. So the first question that we are supposed to solve is what to calculate for the fair value loss or gain. And then the second one, P or L extract. And then the third one is what? Financial position. So financial position extract. So these are the things that we are supposed to what? We are supposed to solve. And remember, the question has been given to us and we have the cost of property to be what? 5,400,000. Accumulated depreciation, which is 2,400,000. Fair value of the property, we have 2,700,000. Rental income earned during 2024, we have 420,000. And then repairs and maintenance expenses, that one too, we have what? 35,000. And we are supposed to solve for this. So the first thing that we are supposed to do is to what? Is to calculate. Right now we want the fair value or what? The fair value loss or fair value gain. So we know our fair value in the question. Fair value. So we have what? Fair value of the property. Of the property. And that one is what? That one is 2,700,000. So we have 2,700,000. So we want to what? Find whether we have a fair value loss or a fair value gain. So what do we have to do? We have to find for what? Our carrying what? Amount. So remember, our carrying amount, whenever you want to find for a carrying amount, we have what? So we have carrying amount. Remember, we have what? The cost minus what? Accumulated depreciation. So now in the question, we have our cost to be what? Our cost of property is 5,400,000 Ghana cedis. So 5,400,000 what? Ghana cedis. Minus, now, then you check the accumulated depreciation that you have here. So the accumulated depreciation that we have here is what? 2,400,000. So this is the accumulated what? Depreciation that we have. So when you check the carrying amounts, so we have our carrying amount, which is what? Which will be 3 what? Million. So 3 million what? Ghana cedis. So this is our carrying amount. So we have been able to what? We have been able to calculate for our carrying amount. So what we have to do is we have to compare the carrying amount to the what? The fair value of the property to know whether we will get what? A revaluation surplus, sorry, whether to get what? A fair value loss or what? A fair value gain. So when you compare the two, we have what? Fair value of the property, which is 2,700,000. And then we have carrying amount to be what? 3 million. And remember, for the fair value, gain. If you want to calculate for your fair value gain, is so we have our fair value. Our fair value is supposed to be what? Greater than the carrying amount. Carrying amount. And then fair value loss. That one to our fair value. So that one to our carrying amount has to be what? Greater than the fair value what? Amount. Now, I want us to look at something here. The way we calculate for the fair value gain and fair value loss is the same as the revaluation surplus and the revaluation what? Loss. When you come here, the revaluation surplus is just what? Replaced by fair value gain. And when you come here to the revaluation loss is what? Replaced by fair value loss. So here you even have what? It already. So it's the same principle that we use. Now, let's check. We have our carrying amount to be what? 3 million. And we have our fair value to be what? To be 2,700,000. So which one is what? The biggest. Our carrying amount is what? Bigger than our fair value. So it means we are going to get what? We are going to get a loss because our fair value is less than our carrying what? Amount. So we have what? Our fair value loss, which will be equal to what? So we have our carrying amount minus what? Fair value what? Amount. Someone may be like, why are we saying that we get what? A fair value loss? Because right now, we know that we bought the asset to be what? 5,400,000. Depreciation is 2 million what? 400,000. We have calculated, we have subtracted the depreciation from what? The cost itself. We have gotten the carrying amount. So we assume that right now, if you want to, we the company, we want to what? Sell the asset. We are supposed to get what? 3 million what? Ghana cedis. But when we went to the market, they told us that right now, the asset does not worth 3 million Ghana cedis again. If you want to sell it, we will get what? 2,700,000 Ghana cedis, which is less than the what? The cost that we have calculated for. So it means if you are going to buy something, and or let's say you want to sell your thing, and you went to the market, you told the person that, oh, I calculated it and I have to what? Sell it 3 million Ghana cedis. And then the market people told you that no, right now you won't get the same figure. We buy this asset 2,700,000 Ghana cedis. So it means the money that you have estimated to what? To sell the asset has to be reduced, which will become what? A loss for you because you have calculated for it again already. You have estimated it already, and right now you are not going to get it. So it will be what? A loss for you. So our fair value loss will be equal to what? Our carrying amount, which is 3 million Ghana cedis minus our what? Fair value amount, which is 2,700,000 Ghana cedis. So when you calculate this, you are going to get what? 300 what? 1,000 Ghana cedis. So this is going to be what? A loss, fair value loss. So since it's fair value loss, it has become what? An expenses that we are supposed to pay for. So when you go to what? The profit or what? The profit or loss, statement of profit or loss extract is going to be an what? An expense that we are supposed to what? Pay for. Because what we wanted to get, we didn't get the what? The amount itself. But right now, we didn't also get what? Let's say like higher than the amount that we were supposed to what? Get. But we have gotten what? Lesser the amount that we were supposed to get. So it means we have to what? Pay for it. It will become what? An expense. So we have what? Our B, which is statement of profit or loss extract as at for the year ended. For the year ended 31st. So because of the space, 31st December 2024. So we have it here. And then you have your what? Your CD sign. So we have our CD sign also here. And then we have what? Income. Remember, statements of profit or loss, we deal with what? Income and what? Expenses only. The first thing that you are supposed to talk about is what? So you look through the question. Remember, we have what? The cost of the asset. We have used it already. Depreciation is what? An expenses that we are supposed to pay. So it will go to an expense. Fair value of the property. So this one is not what? It's not an income for us. That's the fair value. And then we have used it. And then we have what? Rental income and during 2024. So we have what? Rental income. So rental income. So the rental income is given to us as what? 420,000. So this is what? Our rental income. So that is going to be only income that we are going to generate from what? The assets. That's the only income. And then we go to what? We go to the expenses. As I said, it's based on what? Income and expenses. When you talk about statement of financial profit or loss. So the first thing that you have to think about here is what? You had a loss which you have to pay for. So this has become what? An expense. So we just have to what? Send it. So we have our fair value loss. So our fair value loss will be what? 300,000. So we have what? Our 300,000. That's our fair value loss. Now you go to the question. You see that we have what? Depreciation. So depreciation for the year, we have to what? Calculate for it. So we have what? Depreciation. So depreciation in the question, which is what? Depreciation is 2,400,000. So that's what the depreciation. We have to pay for it. It's an expense. And then we look into the question again. So we are that fair value. It's not income or what? An expense. Rental or income. You have recorded it already. And then we have what? Repairs and maintenance. So we have repairs and what? Maintenance. So the repairs and maintenance will be what? 35,000 Ghana cedis. Now, when you are done, it's what? An extract. So we don't add anything or what? Subtract anything from anything to get loss or what? Profit. It's an extract. Now, someone will say that repairs and what? Maintenance. How does it become what? An expense. Remember, when you are hiring what? Let's say a building. You are renting a building. You are renting a building out. Let's say after the people that you rented the land to, after they program everything, they deleted what? The place, and right now they've left. So what do you have to do? It's your property. So you have to what? Tidy up the place in order to attract another people to come and rent. So you tidying up the place. Remember, you are going to hire people to what? Clean up the place or tidy up the place. The people, you are going to pay them. So that's what? That's about the repair and what? Maintenance. Let's talk into what? Assets. So let's say a car. You've rented out a car. And after the people who rented out the car, after the people who rented, The people that you rented out the car to has what? Has brought the car. But you've noticed that right now there's one tire which is not functioning well. So you have to what? Change it. So that one will become what? Your repairs and what? Maintenance. You have to what? You have to do maintenance on the what? On the car. So that will become an expenses that you are supposed to what? Pay. I hope it's okay now. So this is what? The statement of profit or loss what? Extract for the year ended 31st December what? 2024. Please, when you get to the 31st December 2024, write it in full. It's because of space. That's why I wrote it like this. So you write it in what? In full. Now let's go to the third one, which is what? The financial position what? Statement of financial position extract. So with the statement of financial position extract, I'm rubbing here once we are done. So they see we have what? Statement of financial position as at 31st December 2024. So when they talk about statement of financial position as at 2024, the statement of what? Financial position, we are dealing with what? An asset. The investment income is what? An asset. So we are dealing with what? An asset. So we write assets. So we have assets here, and then we have our CD sign what? Here. So after having this, then you check what assets are we talking about here? It's an investment what? Property. So here they are saying that Every Properties Limited owns several what? Commercial buildings. So it's what? Building. We are talking about building here. So you write what? Commercial building or what? Building. So you write building. So the building. How are you going to what? Are you going to indicate or locate the figure for the building as at 31st December 2024? So the 31st December 2024 is when we were what? Preparing the account. And remember, they gave us on the 24th what? Sorry, on the 31st December 2024, let's assume that we wanted to what? Sell the asset out. When we went to the market, they told us that if we really want to sell the asset out, because we have used the assets which we have calculated for what? Depreciation from it, the figure, the amount that we used to buy, which is the 5,400,000, has reduced. So right now, if you want to sell the building, we can only get what? Which is the fair value. We can only get 2,700,000. So this 2,700,000, which is what? The fair value in the question, will be the figure that is supposed to come into what? The financial position. That's the statement of financial position. Because as we were closing our account or preparing the account for the last day of what? Operation, the asset, we can only sell it for what? The 2,700,000 Ghana cedis. So that will what? That will come into our financial position. So we have what? The 2,700,000. So that will become what? The figure. And when you have this, remember, statement of financial position, it deals with what? Three things. We have assets, equity, and what? Liability. Which equity is the same as what? Your capital. But here, we don't have any liability here. Someone will be like, oh, I have expenses that I'm supposed to pay. So it's what? Liability. No. This is different. This is what's different. Here, we are going to use it to find for what? Profit or loss. Profit or what? Loss. So after finding for that, it means these ones cannot what? Come here anymore. You understand? It cannot come here anymore. So since it's only asset that we are having, the person didn't tell us about the capital that they used. The cost for the property doesn't mean that it's capital for what? The company, which is Every Properties Limited. So the building, we can only sell it for what? For which is the fair value. When you get to the financial position as at 31st December 2024, we use the fair value what? Amount to represent it, because as at 31st December 2024, if you want to sell the assets, this is the figure that you are going to get. So this is the what? The figure that we are supposed to record the assets to be. So this is what? The statement of the financial position. And remember, it's what? Extract. Sorry, I didn't bring this. It's extract. So we don't want add anything and subtract anything. So this is it. So we are done with the question. Okay. So let's take another question. So this question says that on the 1st January 2023, company XYZ purchased an office building for 5 million Ghana cedis to what? To earn rental income. The company adopted the fair value model under IAS 40. The question is saying that additional information, directly attributable transaction cost as at acquisition, 100,000 Ghana cedis. The building fair value were as follows: 31st December 2023, 5,600,000 Ghana cedis. 31st December 2024, that one too is what? 5,250,000 Ghana cedis. The property is not depreciated under the fair value model. The property is not depreciated under the fair value model. Rental income earned during each year is 400,000 Ghana cedis. The property expenses is 80,000 Ghana cedis for every year required. Determine the fair value or gain to be recognized in the statement of profit or loss for each year. B. Prepare the relevant extract of the statement of profit or loss and statement of financial position for 2023 and 2024. Now, so this question is in two folds. We have to prepare what? For 2023 and what? 2024. So, the first thing, we have what? Company XYZ. So, company XYZ. They are saying that they purchased what? An office building for 5 million. So, it means purchase cost. Cost is what? 5 million Ghana cedis. 5 million Ghana cedis. And they are saying that the company adapted the fair value model under what? IAS 40. So it means under IAS 40 is what we are going to use to what? Solve this question. So additional information, directly attributable transaction cost at acquisition, which is what? 100 or 1,000. So we have directly attributable what? Cost. That one is 100,000. So they are saying that the building's fair value. So here we have what? The building's what? Fair value for the year. So we have building's fair value for 31st December what? 2023, and then 31st December what? 2024. So for December 23, it was 5,600,000, and then 24 it was 5,250,000. Now the question continues to say that the property is not depreciated under the fair value model. Rental income earned during each year is 400. So income earned is what? 400,000. And then we have what? Property expenses. So we have what? Property expenses. That one too is what? 80,000 Ghana cedis. So this is the question. This is the fair idea. And right now, the first question that they are asking us is to what? Find for fair value loss or what? Or gain. So we have our fair value loss or gain. So let's start. A. Fair value loss or what? Gain. Now, before we can find this, the first thing that we are supposed to find is what? Is to find for the carrying amount. And remember, they are saying what? There is no depreciation. So the carrying amount amount is equal to your cost minus what? Accumulated depreciation. But here, the question, there was no what? Depreciation given. So depreciation is what? Automatically 0. Now, let's talk about the cost. They gave us the purchase cost of what? Of the asset or the building to be 5 million. And they are saying that directly attributable what? Transaction cost at acquisition. So it means the day that we were buying the assets, that's the same day that we are out, we were making the transaction. The transaction, when we were making the transaction, they deducted what? 100,000 on what? On the 5 million that we were sending. So it means this figure has to be added to what? The 5 million for us to get the total cost. Remember, it has told you that what? Directly attributable what? Cost. So it means we have to add it to the cost to get the total cost of what? Of the asset. So the total cost. So if you want to find for the cost is equal to what? Purchased cost plus direct what? Cost. Direct cost. Which we have the purchase cost to be what? 5 million. 1, 2, 3. Plus. And then we have what? The direct what? Cost. Which is, so our cost will be what? This plus this, which will give you what? 5,100,000 what? Ghana cedis. So this is going to be what? Our cost. So this is our cost. Now let's find for what? The carrying amount before we can find for the fair value loss or what? Or gain. Now we have our cost here. So our carrying amount. I'm doing everything step by step for you to what? Understand. So our fair value, we know the formula already. Cost, which is what? 5,100,000 what? Minus what? Depreciation, which is what? 0, because it was not given. So it means our carrying amount. So our carrying amount will be what? 5,100,000. So now, this is what we are going to what? Use to compare whether we will get what? We will get a fair value loss or what? A fair value gain. So we are going to compare for the what? For the 2 years. So when we come, we have what? Fair value loss or gain for 2023. So this is what? The first question. So for 2023, the fair value amount was what? 5,600,000. So we have our fair value amount to be 5,600,000. And we have what? Our carrying amount. So our carrying amount is what? 5,100,000. So these two, when you compare, which one is what? The biggest. So you see, when you compare, the fair value amount is what? Bigger than the carrying amount. So it means you are going to get what? A fair value gain. We have estimated that the assets that we are going to sell, which is what? The building, we are going to sell it at where? At 5,100,000 as at 2023. And when we went to the market, they told us that they can only buy the assets for what? 5,600,000. So it means the money that we estimated for, we have gotten more than that. So it means what? It's a gain or what? An income. So we have what? Our fair value gain, which will be what? The fair value amount minus carrying what? Carrying amount. So we have fair value amount, which is 5,600,000 minus the carrying amount, which is 5,100,000 thousand. So when you subtract, you get what? You get 500 what? Thousand Ghana cedis to be your fair value what? Gain. So we have our fair value what? Gain for 20 what? 23. So the fair value gain for what? 2024. Let's solve for that one too. So fair value whether gain or what? Fair value loss or gain for 2024. So that one too, we have what? Our fair value, which has been given to us in the question. Fair value amount. So fair value amount has been given to us, which is what? 5,250,000. And then we have what? Our carrying amount. So we use the same carrying amount to be what? 5,100,000 what? So that's what we are going to use. So when you compare, we see that our fair value amount is also what? Bigger than the carrying amount for 2024. So it simply means we are going to get what? A fair value gain. So the fair value gain will be what? So instead of me stating this one, you see what? It's here. So let me state it straight for you because of space. So we have what? We have 5,250,000 what? 1,000 minus 5,100,000 what? 1,000. So this one you get what? So when you subtract this, you get 15 what? 150,000, sorry. So you get what? 150 what? 1,000. So the 150,000 will be what? Your fair value gain for what? 2024. That will be your fair value gain. Now, let's go to the what? The next question. So it means we are done with the first question. So let's go to the second question, which is saying we have to prepare what? Statements of profit or loss for the year ended 2023 and what? 2024. So first thing, we have what? The B. Statement of profits or loss for the December 2023. So you see that the dates are what? Really important. So as I said, when you come to the statement of what? Profit or loss. So sorry, here extract is supposed to come here because we are dealing with what? Extract. So the date is what? Really, really important. So whatever we are doing here is for only what? 2023. So we have our what? Our income. And bring our CD sign. Now, let's delve into what? The income. Remember, the first thing that you have to think about is what? Fair value what? Gain or loss. In 2023, we had what? A gain, which is what? An income. So the gain that we had, which is 500,000. So we have what? Fair value gain. Then you count 500 what? 1,000. So the 500,000. Now the second thing that you have to think about is in the question they said during the year they earn an income of what? 400,000 for the what? For the renting. So we have what? Income earned. So we have income earned. Income earned. That one was what? 400,000. So we are done for the income. This is the information that we have about what? The income. Now let's go to the expenses. So when you go to the expenses, we have what? They are saying that property expenses. So as I explained, assuming it was land, or let's say assuming it was what? A vehicle. And after what? After the people have brought the vehicle to you, the owner, you notice that the tire is what 40, so you have to change the tire. That one will become what an expense for you to what cater for. So we have what property expense, property expenses. So that one to be built 80,000 Ghana cedis. So this is the extract for what 2023. So we are down for the what extract for the 2023. We are done for the extract for the 2023. Remember, in the question, it was stated that we had an income of what 400,000 every year, which is what each year, and then expenses to be what 800,000 each year. So it means this income and then this expenses is going to what is going to be in the what, statement of profit or loss extract for the year ended 2020 what 2024. So let's do the 2024 as well. When we come, we have so the B, still we are on the what the B, statement of profit or loss extract for the year ended 31st December 2024. So you see the difference. This 2024 and this what 2023. Now with this one, remember we are starting with what our income as well. So we have income, we have our currency sign. So income. So here for 2024 we also had what a fair value what gain. So fair value gain of what 150,000. So fair value gain, which is what 150,000. And in the question they said that we had what an income earned 400,000 Ghana cedis for each year. So it means in 2024 we ended what we earned 400,000 Ghana cedis. So income earned, that one too was what 400,000 Ghana cedis. And they said we also paid for what an expenses, which is property expenses 800. So we are done with the income. So we come to what expenses. So with the expenses we have what property expenses, which is what 80,000 Ghana cedis. So we are done for the what profit statement of profit or loss extract for the year ended 2023 and the what 2024. So you see the difference. We earn income and what the expenses, the same what figure for each year. So the only difference that you get is what your fair value gain for 2023 and your fair value gain for 2024. Now let's go for the last one. So we are done with this. So the last one will be the financial what statement of financial position, assets 2023 and what 2024. So question C. We have the C. So we have statement of financial position, assets 31st December 2023. So as I said, we are dealing with what? As I said when I was solving the first question, we are dealing with what? Assets here. So the assets, it was what? Building. So we have what? Our assets. Then we have our currency what? Sign. So remember, we want to know, as at 31st December 2023, we want to know the value of the assets. And right now, they have given us what? The fair value as at 2023, December what? So if you check the date, it's what? The same thing. It's the same thing. So we have to what? Write building. So we have what? Building. So the building. Then we have what? The building figure for the fair value, which is 5,600,000. So this will be what? Our financial position for the what? Financial position as at 31st December 2023. That will be our what? That will be our statement for financial position. And then the last one, which is what? Also the C4 2020 what? 2024. So statement of financial position. Sorry, so here I have to bring extracts. Position extracts as at 31st December 2024. So you see, we are preparing for 2024 and what? 2023. So assets, you underline, you bring your currency sign. So now, the same as we did for this one. So you go. We are talking about what? Building. So building. Then you come. Fair value for what? 2024, which is 31st December 2024. So this date is the same as what we have here. So we take the fair value right now. If you want to what? Sell the asset or sell the building, this is the money that we are going to get. So this will be our what? Our figure for the financial position. So we have 5,250 what? Thousand Ghana cedis. So this is what? This is the full question. This is the solution for the full question. So you see, this one was different from the first one because for the first one, it was only requiring for what? Only 1 year. But with this one, the question is what? Asking for 2 years, which is 2023 and 2024. And the question was specific. They gave you the figures. They said for the income and it was what? For each year, which is 2023 and 2024. And then the property expenses each year, which is 2023 and 2024. And they asked us to find for what? The fair value for 2023 and 2024, which we did. And then profit or loss, statement of profit or loss extract for the year ended 31st December 2023 and 2024, which we have done what? We have done it here. So we have the 2024 here, the 2023 I have what? Rubbed it. And then we have the statement of financial position extract as at 31st December what? 2023. So that one we talk about what? We are dealing with assets. So we have the assets here. And then we are dealing with what? Statement of financial position. So that one too, we are dealing with what? We are dealing with it. So someone may ask, directly attributable what? Cost. So when you watch the PPE, which is IAS 16, when I was teaching you about the things that we are supposed to include, the component to include in what? PPE. I said something like what? Anything directly what? Attributable to what? In bringing the asset into its useful state. So I mentioned what? Installation, delivery, etc. So with this ones, directly what? Attributable. So it means without this cost, we wouldn't have what? Gotten the assets. We wouldn't have gotten the what? The building, because the building we are supposed to what? Pay for it before we can get the document. And right now, this is the figure. But when we sent, the time we sent the 5 million Ghana cedis, they deducted 100,000 Ghana cedis. So it means if we decide not to pay for the 100,000 Ghana cedis, we can't get the building. And since it's what? Directly attributable cost, we have to add it to the original cost itself for us to get the total cost. So when you check for the PPE, you know that I've explained all the components. So the component that I explained there, it applies here. Remember, the only difference between IAS 16 and IAS 40 is what? The IAS 16 is owned by the company and used by the company themselves or itself. But for the IAS 40, the property or the asset is owned by the company, but used by what? Different company or institutions. Owned by the company, but the company does not use it. The company doesn't use it, but rather different company. UPSA has bought what? A motor van. They are not using the motor van, but whenever Legon needs what? A motor van, then they will come and what? They will come and rent the motor van. So you see, UPSA is having the motor van, but they don't use it. It's Legon who has been what? Using it, which they pay for it. So they rent it out. That's the difference between what? PPE and what? Investment property, which is the IP. So when you check all the procedures that are used to teach the PPE, is the same as this. Remember, it's UPSA what? UPSA concept that we are using. So we are what? Restricted. We are not supposed to go wide. So we are restricted. This is what we are supposed to know. How to calculate for the fair value gain or loss, which I explained that is the same as revaluation what? Surplus or revaluation loss. So don't let the name, the changing of the name to what? Confuse you. It's the same approach. Use that same approach and then what? You will get it. So every question that you will get under investment property, it will be what? It will be specified for you to solve it. Don't forget the cost and don't forget the depreciation. Here we didn't calculate for any depreciation because it was not given. But you may get a question that will require what? For you to calculate for the depreciation and then what? Subtract it from the cost to get your what? Carrying amount. So that one we did it in what? In the first question. So this is all about IAS 40, which is investment property. Thank you very much for watching, and I will see you in our next video. Thank you very much. Bye bye.